Something quietly changed at FTMO recently. Traders in certain regions went to sign up for a swing account and found the 200,000 option gone. Some found the 100,000 gone too. No announcement, no explanation, just removed. And when you understand why, it tells you everything you need to know about how prop firms actually make their money. Welcome back to Trading Mind HQ. If you haven't watched our first video yet, the one about the harsh truth behind prop firms, I'd strongly recommend you do that first, because what we're covering today builds directly on it. Today we're going to break down why FTMO is restricting swing accounts, what that decision reveals about their business model, and why, if you're serious about passing a funded challenge, swing trading might actually be your biggest edge. In our last video, we established one critical truth about prop firms. When you trade a funded account, you are trading a demo account. Your trades never hit a real market. The firm pays out your profits from their own pool, a pool that is largely funded by traders who failed their challenges. This means the prop firm's income has two sources: challenge fees from traders who fail, and the profits they keep from traders who are funded but not yet profitable enough to request payouts. The moment a trader becomes consistently profitable, really profitable, they stop being an income source and become a cost. Keep that in mind as we talk about swing accounts, because it explains everything. Here is what makes a swing trader dangerous to a prop firm's business model. A swing trader holds positions for days, sometimes weeks. They trade higher time frames, the 4-hour, the daily, the weekly chart. They use wider stop losses, smaller position sizes, and they let their trades breathe. And here is the critical difference. Swing traders are far less likely to hit the daily drawdown limit. Think about it. FTMO's 5% daily loss rule is the #1 reason traders get wiped out on funded accounts. It catches intraday traders who have a bad session, overreact, and blow past their limit in a single day. A swing trader on a daily time frame almost never does that. They risk 0.5 to 1% per trade. They don't overtrade. They don't revenge trade after a loss because their next trade setup might not appear for 2 or 3 days. Swing traders pass challenges at a higher rate. They stay funded longer. They draw down less. And they request more payouts. In other words, swing traders cost prop firms more money than day traders do. And here is the data that makes this undeniable. FTMO's own swing account comes with lower leverage, 1 to 30 versus 1 to 100 on a standard account. That lower leverage forces smaller position sizes, which reduces volatility in the trader's results. Combined with the freedom to hold through news events and over the weekend, swing traders have a structural advantage in staying within the rules. So when FTMO starts quietly removing the 200,000 swing option in certain regions, the question you should ask is not, what changed in those regions? The question is, were swing traders at the 200,000 level becoming too profitable for FTMO to sustain the payouts? Based on the business model we broke down in video 1, that is the most logical answer. So here is the takeaway that most traders get completely backwards. Most traders attempt prop firm challenges using short time frames. 5-minute charts. 15-minute charts. Scalping. High frequency. They think more trades means more opportunities to hit the profit target. But more trades also means more exposure to the daily loss rule, more emotional decisions, more overtrading, more revenge trading after a bad session, more chances to blow the account in a single afternoon. Swing trading flips all of that on its head. On a higher time frame, you might take 3 to 5 trades per week, each one carefully selected. Each one with a clear setup, a defined risk, and a target that gives you a genuine risk-to-reward ratio of 1 to 2 or better. You are not glued to a screen all day. You are not making impulsive decisions under pressure. You place your trade, set your stop, and let the market do the work. This approach maps perfectly onto how FTMO's rules are structured. No time limit on the challenge means you can take your time. The 10% maximum drawdown is static, not trailing, which means a disciplined swing trader with small position sizes has enormous room to operate before they are ever in danger. And the swing account itself, where it is available, removes the two biggest landmines for funded traders: news restrictions and weekend holding limits. You can hold your gold trade through a Friday close. You can stay in your DAX position over a central bank announcement. The market moves that most day traders are forced to step aside for are the exact moves that swing traders profit from. The irony is this: FTMO built a swing account because it attracts profitable traders. And profitable traders, as we now understand, are exactly what makes the swing account expensive for them to keep offering at scale. So, what does this mean practically for you? First, if the swing account is still available in your region, use it. The structural advantages are real. Lower leverage forces better discipline. Freedom from news and weekend restrictions gives you more flexibility. These are not small edges. They are fundamental advantages in how you manage the challenge rules. Second, even if you use a standard account, trade like a swing trader. Move to the H4 or daily chart. Cut your trade frequency. Focus on quality setups, not quantity. Risk no more than 1% per trade. Give your positions room to develop. Third, understand that the prop firm's rules are not designed to help you succeed. They are designed to filter out undisciplined traders quickly. The daily loss limit, the drawdown cap, the news restrictions on standard accounts. All of these are more dangerous to a reactive, impatient day trader than they are to a patient, structured swing trader. The fact that FTMO is restricting the highest value swing accounts is not a reason to avoid swing trading. It is confirmation that swing trading works, well enough that the firm needs to manage its exposure to it. That is the clearest signal you will ever get from the industry that you are on the right path. In our next video, we are going to go deeper into exactly how to build a swing trading strategy that is specifically designed to pass a prop firm challenge, the timeframes to use, the instruments that work best, and the risk management rules that keep you inside the drawdown limits while still hitting the profit targets. If you found this video useful, subscribe and hit the notification bell. We put out new trading education every week, no hype, no noise. And if you haven't watched our first video on the harsh truth about prop firms, the link is in the description. It will make everything we covered today make even more sense. See you in the next one.